Welcome to another Explainer. Today, we're diving straight into the numbers, the strategies, and the real market realities that are driving today's corporate landscape. We're actually going to perform a bit of an earnings autopsy on Marriott Vacations worldwide, zeroing in on their Q1 2026 results. And you know, it's a genuinely complex, fascinating story. We're looking at a company that is somehow generating higher revenues, yet dealing with plummeting profits, kicking off major strategic pivots, and facing a radically divided reaction from Wall Street.
So let's start with the brand itself. Marriott Vacations Worldwide is an absolute giant in the global vacation industry. We're talking over 120 vacation ownership resorts and a truly massive exchange network. But they just reported some mixed financial results that have essentially triggered a massive operational shakeup for the rest of the year. Make no mistake, we are looking at a company at an absolutely critical inflection point.
Here is our roadmap for today's Explainer. First, Q1 earnings top-line results. Second, inside vacation ownership. Third, management strategic action plan. Fourth, debt and liquidity overview. And fifth, Wall Street's verdict.
Okay, Section 1, Q1 earnings, top-line results.
Let's dive right into the hard numbers from Q1 to establish the current reality of the business. You know, the headline revenue number actually looked pretty good on the surface. Marriott Vacations saw modest year-over-year revenue growth, beating Wall Street's estimates by roughly 4.6% to hit $1.26 billion. That's up from $1.2 billion the previous year. Now, you might look at that and think, hey, great, the business is growing, right? Well, here is the catch. Despite bringing in higher revenue, their actual profitability took a severe hit. Net income absolutely plummeted from $56 million in Q1 of 2025 all the way down to just $22 million in Q1 of 2026. Because of that, diluted earnings per share dropped from $1.46 down to just 64 cents. So sure, they brought in way more money at the top, but they kept significantly less of it at the bottom. And we see that exact same story play out when we look at adjusted EBITDA, which is a metric management heavily relies on to evaluate their core profitability. It dropped 16%, falling from $192 million down to $161 million. Management pinned this margin decline on a few things: lower contract sales, increased marketing and sales costs, higher product cost, and taking a hit on increased unsold maintenance fee expenses. Honestly, it was just a softer overall quarter.
Moving to Section 2, inside vacation ownership. So what is actually causing this massive profitability squeeze in their core vacation ownership segment? Well, the decline in sales tours wasn't exactly an accident. The company made highly planned, strategic decisions that led to a 3% drop in overall tours. First, they specifically shifted focus to prioritize higher profitability and cash flow over in the Asia-Pacific region. But perhaps more notably, they made an active, conscious decision to reduce tours to prospective buyers with FICO credit scores below 640. They are quite literally intentionally weeding out lower credit prospects.
And the reasoning behind that is pretty fascinating. While the total number of tours dropped, the really crucial takeaway is that volume per guest, or VPG, actually increased by 1% year over year. In fact, if you exclude those Asia-Pacific shifts, it was up nearly 50 basis points. So this tells us that while fewer guests are taking the tours, the guests who are touring are much better qualified and they're spending slightly more. They are explicitly trading quantity for quality.
Let's look at Section 3, Management Strategic Action Plan.
Now, trading quantity for quality on the sales floor is great, but it isn't nearly enough to fix a 61% drop in net income. As CEO Matt Averill explicitly stated, they are taking major steps to strengthen their foundation. And guys, this isn't just tinkering at the edges. This involves significant changes to their executive team, bringing in brand new, experienced sales and marketing leadership, making incremental cost and overhead cuts, and launching a really aggressive asset disposition strategy.
This timeline lays out their non-core asset sales strategy perfectly. It's designed to quickly generate cash and support deleveraging. They actually started off strong, right out of the gate this quarter, by closing the sale of a Westin Cancun hotel, which brought in $50 million. For the remainder of 2026, they expect to list more non-core assets to generate over $125 million more. And looking ahead to the end of 2027, their target is a massive $200 to $250 million in gross cash proceeds.
But beyond just selling off properties, management laid out some very clear, non-negotiable priorities for the rest of 2026. They are hyper-focused on improving free cash flow conversion through tighter working capital. They want to radically lower their cost base through strict operating discipline, and crucially, they absolutely need to protect their recurring, high-margin revenue streams, like their financing and management businesses. Those streams provide a vital layer of durability while the rest of the business recalibrates.
Next up, Section 4, Debt and Liquidity Overview.
So why the sudden, aggressive rush to raise cash? Well, if you look under the hood at the company's balance sheet, it tells a story of very heavy leverage. Yes, they are sitting on a solid $854 million in total liquidity, which includes their cash and available credit. However, they are carrying a profoundly heavy load, $3.3 billion in corporate debt and another $2.3 billion in non-recourse debt. That is a massive amount of leverage, especially in a macroeconomic environment where interest rates are still running high.
Let's quickly break down that $2.3 billion of non-recourse debt. It is largely what's called securitized debt. Because Marriott Vacations finances a ton of the timeshares they sell, they generate thousands of IOUs from their customers. Securitization simply means they take these customer vacation ownership notes, bundle them into a giant pool, turn them into tradable securities, and sell them off to investors. It's a really common way to spread risk and generate immediate cash flow. But it requires healthy, consistently paying borrowers, which completely explains why they are suddenly restricting tours for guests with lower credit scores.
And to keep this huge lending engine running smoothly, before they actually bundle and sell those loans, they heavily utilize something called a warehouse credit facility. You can essentially think of this as a massive temporary corporate checkbook that covers upfront costs. It's completely necessary to run the business, but it definitely isn't free. Just in the first quarter of 2026 alone, borrowing from this facility generated $3 million in interest expenses.
Finally, Section 5, Wall Street's verdict. So, putting it all together, we have a company with rising revenues but falling profits, carrying a significant mountain of debt, and undergoing a pretty major executive shakeup. With earnings per share completely missing estimates and net income falling by over 60%, how exactly are the Wall Street experts pricing in this risk?
What is absolutely wild here is the incredibly polarized split in the consensus. 66% of analysts are actually still bullish, recommending a buy or strong buy. They likely believe in the long-term value of the brand and think these new cost-cutting measures will work. However, a full 33% recommend a sell or strong sell. And notice what's completely missing here? Exactly 0% of analysts recommend a hold. Wall Street is completely, totally divided on this stock. It is a literal battleground.
And you can see that uncertainty directly reflected in the price targets. While the stock price hovered right around $88.17 shortly after the earnings release, the Wall Street consensus target is significantly lower at just $77.78. That indicates an anticipated decrease of nearly 12%. The market is essentially saying, look, we hear the plan, but we really need to see the proof.
So we leave you with this final thought to chew on. Marriott Vacations Worldwide is betting big on better qualified buyers and a really aggressive asset sell-off to correct their margins. But can management's massive pivot to clear out non-core assets and chase higher FICO scores actually outpace the rising costs that are currently dragging down their bottom line? That is the multi-billion-dollar question for 2026. Thanks so much for joining us for this explainer, and we will catch you next time as we continue to unpack the fascinating stories hiding right in the numbers.